Well, hello everyone. Welcome to Getting Started with Options. My name is Barbara Armstrong. I'm a coach with Schwab, and I have some announcements to make today, so I'm so glad you're here. Today we're going to talk about a bullish strategy called a short put, and you may be saying like, hey, just a minute, back the truck up. I thought puts were bearish, calls were bullish, and you'd be 100% right. If we're buying a put, we're bearish. But if we're selling a put, that's actually a bullish or bullish to neutral strategy. And we're going to kind of, talk about that. If you're brand new to this webcast, you are welcome to type a greeting into the chat so that we can say hello. We have a lot of what I fondly call our usual suspects here, including Will and Riceberg, who were at the last in-person event of the year in Houston last weekend, along with, Tony and Bob and Jay and Austin and Josh and Lisa and Jack and Priya and Shiva and the rest of the gang. Thank you all for being here and bringing this class to life. We have Cameron May with us in the chat. He's a coach and friend and knows this topic really well, which is a good thing because come the new year, Cameron is going to be taking over, getting started with options. We're trading places. It's not just, a show that used to be, I don't know if it's even still on. We're not just trading spaces. We're trading webcasts here, and I'm going to be taking over, getting started with technical analysis in the new year. And Cameron will be taking over, getting started with options. And so this is the last time I will be teaching this class that I created, 6 or 7 years ago. So it's a little bittersweet, but I know that you're going into absolutely fantastic hands. If you want to see the new schedule, go to schwab.com/coaching. And I will bring that up. Let me just bring it over here so that you can see the new schedule. I have also posted this on X. So here is live webcasts and virtual workshops. And if you scroll down here and you come to January, you can see the new curriculum. And if you're saying, oh, I love Cameron May, I wonder what he teaches, you can come and type in, click Cameron May, and you can see Tuesdays he'll be doing Getting Started with Options, Wednesday Getting Started with Thinkorswim, so you can see what he's teaching. And then it's like, hey, Barb, what are you teaching? I'll be teaching something every day. The Trading a Smaller Account Mondays and Fridays isn't changing, but the 3 classes wedged in between. Okay. And that's how to easily find it. You can also find the link to this on X. Okay. If you go to my X feed, you're going to want to follow both Cameron and I on X at Barb Armstrong CS, at Cameron May CS. I've come across 2 scammers in the last 24 hours. So just know that neither Cameron or I, no Schwab coach will ever reach out and offer you education for a fee. We'll offer you, suggest that you go to a different trading platform. My guess is you'll deposit money into that account and it'll be gone. We'll never offer you a Bitcoin or crypto deal. So just know there's only one original, and we're never going to reach out to you privately. Okay, so today we're talking cash secured puts. Know that options carry a high level of risk and aren't suitable for all investors. You have to meet certain requirements to trade options with Schwab, and not all will qualify. We use the Paper Money platform on the Thinkorswim desktop platform. It is a brilliant place to learn, how to trade, to become familiar with the platform, all that good stuff. With a cash secured put, if you end up having that position put to you, and that can happen at any time up until expiration, from the time you place the trade until expiration, it doesn't just, the stock can be put to you. So you've got, to be aware that you could end up owning the stock and position size accordingly. Like, in other words, make sure you have enough money in your account. But chances are, if the stock is put to you, it's trading lower than the strike price at which you're going to have to buy it. Okay, so one of the differences is that in paper money, you'll never be assigned early, but this can happen in a live account. Okay, and we'll discuss that. And I've already talked about paper money. So what we're going to talk about today is what a short put or a cash secured put is. Then we're going to look at the basics of selling a cash secured put. Why might an investor want to do this? If they're putting themselves in a position where they might end up having to buy a stock. And then we're going to go over at least one example and do an example trade, and then discuss, like, if you think this is an interesting strategy, what might you want to do next? Where can you go? So when we look at selling a put, what are we getting ourselves into? Well, when we sell a put, we are creating an obligation. So we are saying to the person that we sold this put to, if you, let's go to yellow. It'll be easier to see. If you would like me to buy this stock or the index at this strike price at any time from the time we set up, from the time I sell this up until the expiration date, I'm happy to buy it. That's what we're doing. And if it's put to us, we can't go, JK, I'm just kidding, didn't really mean it. I don't have enough money in the account. And this is why some brokers or some accounts, depending on the type of account, may require it to be cash secured. So if you're looking to buy, you sell a put on a stock at the $100 strike, each contract represents 100 shares. They're going to take $10,000 and say, I'm going to set this over here just in case you need to buy this, $10,000 worth of stock. And so that the money is tied up until you close out that position. So their cash secured means that they've set enough money aside for you to purchase this if it is assigned. Okay. And so if you're saying, well, geez, there's no way I want to own that stock. Well, then don't sell a put, because you could end up owning it. It's a bullish strategy. And as I said, like, one option represents 100 shares. Now, you might say, well, I already own 100 shares. I don't want to own two. Well, if it's put to you, then you might decide to, liquidate that position. And we can, get more into the details or the nuances. And I just like to be able to draw things out. So this isn't a mistake that this is here. So let's just kind of think about this in our mind's eye. So if we have a stock that's been going up and then it pulls back for a few days and then it starts to go up again, and then it pulls back and then it looks like it's going to go up again, could we come down here and say, you know what? I think this is going to continue to go up like this, but I'd like to make a little money. And so one of the reasons that we might sell a put is just because we want to grow the account. So I'm going to sell a put here. It's currently trading at $53. I'm going to sell the 50 put, and let's say I get paid $2 for it. Well, what's the most I can make on this trade? The most I can make is the premium that I got paid to get in. So my max gain on this is going to be $200. That's my max possible gain, is $200. Now, how much could I lose? Well, let's say some kind of bad news comes out, and after we bought this put, it gaps down and keeps on going. Now, the probability of something going to zero is not high, but the most we could lose is our strike price, or 50, minus what we got paid to get in. So our max loss potential, it pulls back for a few days, and then it starts to go up again, and then it pulls back, and then it looks like it's going to go up again. Could we come down here and say, you know what? I think this is going to continue to go up like this, but I'd like to make a little money. And so one of the reasons that we might sell a put is just because, it might be a fairly low probability that it even come back here. But when we place this trade, you'll see that this is how the system calculates it. Even if you put in an exit, if the stock goes, more than a certain percentage below this $50. Okay, but if it continues to go up, what's going to happen to the value of this option? Well, the value of the option is going to go down and become worth less and ultimately worth nothing. Because if we're selling this put and we're saying we're willing to buy the stock at $50, if it's up here trading at 60, the probability starts getting very low that it would come back. So there's less of a market for it. But if it goes down, let's say it goes down, your break even on this is going to be 48, because if you got paid $2 for it and you end up having to buy it when it's trading at 48 and you're paying 50, well, it's kind of a zero-sum game. But if it goes down below that, and as the price falls, this becomes worth more, right? Because if something is trading at $40, I've agreed to pay 50 for it if I've sold this put. Okay, so sometimes people will use a put for protection. So they'll buy a put for protection. And we have that as a whole separate class. Or sorry, that's buying a put. Scratch that. So when we buy a put, it gives us the right to sell it. And we take two classes to talk about buying puts. One, buying a put for profit if something's falling. The other one is buying a put for protection if we own the stock. And that's 2 of our 12 classes. But for this one, what we're doing is we're looking to make money on a stock that we believe will continue to go up. Now, what? Okay, so let's assume that we are looking at a stock that is going up. And when we look at this stock that is uptrending and we say, hey, you know what? It looks like this trend is going to continue. So I'm going to sell a put here at $50. Okay. And if I receive $2 for this payment for this put that I have sold, if the stock continues to go up, the value of this put will go down. And that's exactly what we want to have happen. Because when we sell the put, we want to get paid a lot and then have it go down in value and buy it back for less. And some might put it in, say, well, I would like to just let it expire worthless. Some might say, when I have 50% of my max gain, I want to exit the position. Some might say, when I have 80% or 90%, that's up to an individual trader to establish their trading plan. Okay. But as the value of the stock goes up, which is what we're expecting, the value of this put will go down, which is what we're looking for. Okay. Now, if we are wrong or mistaken and the value, the stock drops in value, then the value of the put that we sold will go up. And that's bad news, because if we're doing this because we're looking to earn some income, our expectation was that it was going to go the other way. And the amount that we can lose is equal to the strike were the stock to go to zero. Now, the probability of that happening might be very, very low. But it could end up being put to you. Okay, so this is our bullish kind of outlook. And if it goes below 50, which is the strike we've sold, it increases the probability of the stock being put to us or assigned to us. Now, what if we see a stock that's going sideways and when it comes down and bounces off this support level, we might say, you know what, here's a good chance for us to sell a put below where it's currently trading, below this support level. And when it gets up and hits the ceiling or the resistance level again, I will buy it back. And then if it comes back down and bounces again, I'll sell another one. And I can do this kind of wash, rinse, repeat with something going sideways. So this is another way of using this short put strategy when something is going sideways. Okay, are there any questions on that? Okay. Okay, so let's get off our blank page then. So what are we looking for? Well, we're looking for, when we go out and go to the platform, which we're doing momentarily, we're looking for stocks that are in an uptrend, right? And there have been a lot of stocks uptrending lately. The market has hit all-time high after all-time high after all-time high this year. So we're looking for stocks that are either in a sideways or a neutral or in an uptrend. And some might also say, if you have a checklist or an example trading plan, and you want to have 4 components, right? What to trade, when to trade it, how much to trade, and when to close out the position. And so this would be part of our, what type of situation are we looking for? And so we might say we want stocks to be in an uptrend. You might also say, and I'd like stocks that are in a sector that's uptrending. Sorry for my messy writing. And I'd like to also see that the market is uptrending or at least going sideways. So you might be looking for 3 checks, and then we're looking, and then this is our when. So here's part of the what, here's part of the when. And so with our when to buy, and we talked about this bull flag pattern with this close above the high of the low day. And so, if we see something that's uptrending like this could be an entry. Or if it's bouncing off a support level, well, what if we threw in a 30-day moving average or a 50-day moving average and it came down and it bounced off that moving average? Or if it's sideways, like I had just drawn out. So these are, part of what we're looking for in an entry also. Okay, we're also looking for stocks that have high trading volumes. Well, isn't this an option trade? So why do we care about how many shares the stock is trading? Well, if the stock doesn't trade very many shares, chances are the options won't either. You might say, well, I'd like to see it trade 1 million shares a day plus. Now, others might say, I want it to be 5 million. I mean, this is your trading plan. You can make it whatever you want. Okay. And then you may say, I want to have options also that have high trading volumes. And on the thinkorswim platform, that's expressed as open interest, number of contracts that were on the books when the market opened, and volume, number of contracts traded today. You might say, well, I want that to be at least 20 times the number of contracts I'm planning to trade. Some might say 10. Some might not even have it on their list at all. They might say, well, hey, as long as the bid-ask spread is tight, and you might say for that, I'd like it to be pennies apart or no more than 10% between the bid and the ask. This is what the market makers paid. So we're going to go out and look for these types of characteristics. Okay. So let's go out to the platform. And I've done a little bit of looking already. Now, one thing that we haven't talked about yet is volatility. And, so here we have Visa. It's been uptrending, up 22% year to date, hitting a new high today. But I want to look at Affirm, actually, as our first example. So Affirm, if you're not familiar with this company, if you come to the Analyze tab, we can see it's part of the financial sector. And you say, okay, well, I think financials have been doing, not too badly. And one of the things that we look at often in other classes is the sectors and how they're doing. So if we come here and we look at financials, it hit a new high a couple of weeks ago, and then it's been kind of pulling back a little, hasn't it? But overall, up 30% year to date. So you could say intermediate and longer term uptrend, shorter term pulling back. How has the stock market been doing? If we look at the S&P 500 as our indication of how the overall market's doing, we can say, well, the S&P 500, it's up to almost 27% year to date, hit a new all-time high, within the last 2 weeks, and is within a stone's throw of it still. And so you could say, okay, sector uptrending, a market uptrending stock has been uptrending, and then it's been kind of going sideways. And so if we look at this and we say, well, that's, interesting. I'm not that familiar with the stock. It's not like it's Apple and, a household name. Let's come and look at the trade tab. How many shares a day does this thing trade? And so if we look at our trade tab here, if we look at the volume on the stock, it's traded over 5 million shares today. So if we're saying, well, our list said we wanted it to be at least 1 million, so check on that. If we come out to January, and if we're looking in that 20 to 50 day time frame, and we're looking at selling a put, so here's our 31 day time frame. If we're looking at selling a put, when we look at our options here below 70, do we have a lot of volume? Well, we have hundreds to thousands of contracts, and quite a few traded today also. And so we can say, okay, check. And is the bid-ask spread tight enough for us? Well, if we looked at this 65 strike, it's 15 cents apart. So that's about 5%. So check. Okay. So next question is, well, what strike might we want to sell? We might say, well, it looks like this line around 66 has been, holding as a support level. It's come up and hit this line multiple times, hasn't it? Sorry, I'm not very good about clearing. So it came up and used it as support there, and then came down and hit it there. It looks like it came down and almost kissed it again today. And this candlestick pattern is indicating that, maybe it's found its support level here. And so maybe could we get enough premium if we sell a strike just below it, maybe around that $65 level, and we could just take this line and edit it and say, how would it look if we sold this 65? And, if we did a cash secured put or a short put, and we could show that right here on the right. And so if it comes down and you might say, actually, I'd like to buy a firm. So there's a couple of different reasons people will consider selling a put. They may do it thinking like, hey, I'd actually like to buy this stock. And so if it comes down and it hits the 65 or goes below it briefly, because it's come down and kissed this 30-day moving average a couple of times in the last, since the end of August. So if I end up owning the shares, I'm okay with that. Now, what always had me feeling a little angsty about that is, well, what if it just continues to go up and then I end up not owning the shares? Well, I get to keep the premium, but I don't own the stock. So I found it like, now if you're saying, well, I'm going to sell a higher strike because then the probability is higher that it will be put to me. So it depends on what you're trying to do here. If you just want to make some money, you're going to put it below a support level where you do not think the stock will go. But if we come up here and we look at the trade tab and we say the 65 strike, we're getting paid $3.10. That's a pretty juicy premium, because it's $3.10 on 65. So if I take 310 divided by a $65 stock, that's about a 5% premium, 4.76. And I'm thinking, okay, well, volatility's got to be high. So when we look at January 17th, this is just our implied volatility is $74. Is 74%. And so what this means is our premiums are going to be really juicy, but the probability of the stock moving, they're saying here, the expectation is that this could move up to $12 a share up or down in the next 31 days. So that IV it creates for higher premiums, but also higher risk. So if we say, we're cool with that, we understand what a firm is, and we're just going to sell, and this is $1 million account. So we might say, you know what, we'd be willing to own 300 shares. That's about a $20,000 position. That's not even this is if it's $1.3 million, if I take 1,300,000 and I say, I would be willing to have a 5%, up to a 5% position in a single stock. So a portfolio of 20 stocks, I'd be willing to have up to a $65,000 position. So that would be, a lot of shares. But if we say, well, okay, we could do 5 times 6 would be 30. So we could say, well, let's leg into it. If we end up owning this, we'll be halfway to our position size. If we did 5 contracts, that would be just over 30,000. Okay, so we're going to sell and we're going to make this 5. And so how much can we make? Well, the most we can make is this premium that we're being paid to enter the trade. When I come to confirm and send, we can see the most we can make is $1,500. The most we can lose is if the stock went to 0. So we're risking 30,000. Now, when we look at this, and I'm going to put this trade in and we're going to come back and look at this because we're going to do a couple of things, in an attempt to protect our position. So this is our short put group. So we're going to send that in. Okay, now with respect to, what are the probabilities? If I come up to my strikes here and make this 30 strikes instead of the default, we can see here, and when we look at this 65, I've added 2 columns. One is probability in the money, and it's saying you have a 37% chance it could be in the money at expiration. And that means you've got a 63% chance it could expire worthless. But if we come down here to the 50 strike, and I'm just going to get out my drawing tool here. So when I get out the 50 strike, we have a probability of that being in the money of only 7% and a probability of it touching 50 of 15. So although it's saying, it could go to 0 and that confirmation page indicated that, the likelihood of it getting down to $30 a share is about 2.5%, less than a 5% probability that it could touch it. And so I find these columns pretty interesting and I leave them up a lot because of that. So what we're going to do on this short put is instead of putting a stop on it, and we could put a stop on it, we're going to come out to the chart and we're going to say, okay, if this goes below $65, I would like to receive an alert. And the alert will go wherever you've set it up to go. It could send you a text, it could send you an email, it could do both. But we're going to say, hey, if this goes at or below $65, let us know, because we may, want to manage, or we may want to exit our short put position. So we'll just look at what's going on and make a decision, but this will prompt us, to make sure that we're aware. Okay. So there's one example. Now let's look at Apple. So today is sponsored by the letter A. So if we look at Apple, it was consolidating for quite some time. And, I posted this on X, I think a week or so ago, actually the day that it broke out. So we have this technical pattern called a cup and handle pattern. And so a technician might say, hey, this has moved, about $38. So the expectation is that this stock might move up $38, to around this 273, 275 mark. And, we haven't had a lot of pullbacks on this lately, like a 1-day pullback here, a 1-day pullback here. could we come back down to this recent support level where the last pullback occurred around this 245 and sell a put at 245? You know, and well, you can do whatever you like. Now, this one, we may not be as worried about, you know, does it trade a million shares a day? It's at 16 million shares. But let me, you know, and if we come out, and again, you know, we don't need 30 strikes. If we were saying we were looking at the 245 strike. So when we look at this 245 strike, you know, we know that it's got lots of shares being traded. When we look at this strike expiring in 31 days, and the 100 means, you know, one contract represents 100 shares. Do we have a tight bid-ask spread? 3 cents apart. So yes. Do we have enough open interest? Well, we wanted to have at least 20 contracts. There's 8,440, 1,200 traded today. There's a 26% chance, this is saying currently, of it being in the money at expiration. A 54% chance, almost 55% chance that it could come and touch it sometime between now and then maybe bounce. Okay. And so we could end up owning it, but look at the premium we're receiving, but look at the volatility. Affirm was 74%. This one is 22. So we're not even getting 1% premium. But if you're saying, I'd like to add Apple to my portfolio, I'm cool with that. It's like getting it for $2.12 a share less. I'm not saying that's how your accountant would look at it, but that's how a trader might look at it. So if we wanted to sell that put, we're just going to right click anywhere on this line and we want to sell a single. And how many of these are we going to do? We're just going to do one because one is a $24,000 position. And we're going to say, well, maybe we're going to leg in. This would be half a position for us, half of our 65,000 or getting close to it. What's the most we can make? $2.11. And we could, you know, say, hey, when we've got 80% of our max gain, we'd like to buy it back. You know, ski season is coming, you know, and so you could put in an exit with, you know, that's a target. And so you could say, hey, when this is worth 42 cents, I'd like to buy it back. And then again, we can put in an alert to say, hey, if this goes below 245, let me know. So we're selling a put because we're bullish. And you know, we could end up owning this. It's saying our max profit 211. We knew that. How much could we lose? 24,289 if Apple went to zero. Do we think it's likely to go to zero in 31 days? Not likely. You know, and again, you know, if you have a morbid sense of curiosity, if you will. Where's my short puts? There we are. Can't see for looking. And then again, we can come up here, click anywhere here, and say we want to create another alert to say, hey, if this goes below 245, let me know. And we're going to manage our short put position or our cash secured put. Yeah, and some might say, you know what, like my rule or part of my trading plan is that if I don't get at least 1%, so if I can't get at least 250, I'm not going to place the trade. And so you might say, yeah, I'm not going to place that trade. I'm not getting enough premium for it. And that would be totally legit. It just depends on what your plan is. You know, we're getting a much higher premium, you know, per se, you know, as a percentage for a firm, but there's more risk in that position also. Okay, so let's go back and wrap up. So our outlook when we're selling puts is we are bullish or, you know, at worst neutral. Often a trader will look in that 20 to 50 day time frame. If you're looking in that 3 to 4 weeks, time decay really accelerates in that last 3 weeks. And so we want to take advantage of that. Our strike often we're, you know, some traders might say, you know, as a rule of thumb, I'm looking for a delta of 20 to 40, or some might say 25 to 50, and you can make this your own. And then some will position size based on max loss. Some will position size based on if the stock is put to them, that, you know, that it's an appropriate position size for their account, so that they're not all of a sudden half of their account value isn't invested in this one stock. And so, you know, this is a way that some people might use this strategy to generate income or to help grow their account. Again, you know, the most we can make is what we're paid to get in when we receive that credit when we get in. And some will use this as a way to buy a stock, to be paid, if you will, to buy a stock that they wanted to buy anyway, if the stock is assigned to them. And we have to know that short options, they can be assigned at any time, regardless of how far they are in the money. You know, and you know, we could end up having the stock put to us when it's trading lower than what we're going to have to pay for it. And we're aware of that. And it's often, you know, considered to be a short to intermediate term trade, that if you're doing this on a bullish stock, you can kind of wash, rinse, repeat, and do it over and over again. So you've got to be, I know I sound like a broken record, but you know, repetition is the mother of all learning, right? So you've got to make sure you have enough money in the account if you are assigned. If not, you'll be, you know, somebody will be contacting you and saying, hello, you need to put more money in your account. And you know, and again, if assigned, and we've talked about this, most traders will want that position to be in alignment with their position sizing guidelines. And you may want to be aware of upcoming earnings or dividends. Some might say, I don't want to trade this over earnings because the stock could gap down and then, you know, I'm in a bad spot. Others will say, I'm going to do this as an earnings trade because I'm bullish on the stock, and that prior to earnings, volatility is higher and I'm going to receive a higher premium. And so you can do it either way. And when volatility is higher, we've seen the difference that can make in premiums. And so when volatility is higher, some might take advantage by selling. Now, when exiting, some will say like 4 to 10 days prior to expiration, I want to eliminate the assignment risk. So part of my trading plan is to get out of that trade by buying it back. Okay. Or they'll say, hey, when I'm at 80%, I've got 80% of my max gain, or 75%. You might say, hey, if I've got 50% of my max gain in a week, I was willing to be in this for 30 or 40 days. If I can get half of it in 5 trading days, I'm out. You know, so, you know, just because you put in an initial target at 80% doesn't mean you can't change your mind. And you might say, hey, if this breaks a major support level, even if I have to buy it back at a loss, I'm going to do that to protect myself to the downside. And you know, if you want to own the stock no matter what, you may choose to do nothing if the stock is falling. So, but you want to have an idea in your head of how you're going to handle that before it happens. And then you're not trading using those pesky emotions like hope and FOMO and fear, right? All 4-letter words. You know, so we've talked about what a cash secured put is. We've, you know, looked at some of the considerations to both enter a trade and exit it. And, you know, we've placed 2 example trades today, both on stocks, beginning with the letter A, Affirm and Apple. And, you know, so thus ends week 6 of our 12-week series. And I will put a link in to the entire series so that if you are new, or if you want to do some binge learning over the holidays, you can, you know, pour yourself a cup of coffee or your favorite beverage, whatever that might be, and do some binge learning. So guys, I thank you for your time and attention. If you haven't hit the like button, it's a chance for you to do a favor for a random stranger without leaving your desk. So hit the like button. It also helps move this up in the algorithm so more people can find this content. Follow us in the Land of X, Barb Armstrong CS and Cameron May CS. And what else? Subscribe. If you haven't subscribed to the channel, like, what are you waiting for? It's free. There's so much great content in there. I would have been in hog heaven had when I started in 2011, stuff had been laid out like that. And after today, I am putting you in the capable hands of Mr. Cameron May. Thanks for being in the chat today, Cameron. Have a great holiday if I don't see you. We are here, right until Christmas Eve. So enjoy the rest of your day. Up next is Trading Flag Patterns with Mr. Ben Watson. Have a great one, guys. Bye for now.